Hi, I'm Srivatsa and I'm the fund manager for the UTI Hybrid Equity Fund. UTI Hybrid Equity Fund is an aggressive hybrid equity fund as per the SEBI classification, where the asset allocation is equity is between 65 to 80% and the balance is invested in fixed income. However, in case of UTI Hybrid Equity Fund, our equity allocation ranges is capped at 75%. We generally range between 71 to 75% depending on the market conditions. The balance is invested in debt securities. Coming to the equity strategy of the fund, the equity is managed with a relative value philosophy wherein we focus on good quality stocks and sectors trending below longer term valuations with a good margin of safety. We also bet on cyclicals where we believe either the valuations are favorable or the cycle is either in the bottom or in the mid cycle with a strong prospects of improvement. Lastly, we also have a decent allocation towards mid and small caps, where our sole focus is to identify growth oriented mid and small caps with a reasonable margin of safety and reasonable valuation. Coming to the key sectors where we are active weight on, these are financial services, automobiles, telecom, and capital goods, and healthcare, while we are underweight on consumers, oil and gas, and information technology. Our portfolio is premised on the fact that we expect a strong demand recovery in the coming year, and we believe that financials and automobiles are the best way to play the strong demand recovery. Also, giving comfort is the fact that the valuations are very reasonable in both these sectors from a longer term perspective. And given the base in the last couple of years, we believe that the chances of them surprising the market estimates of growth and profitability is also higher. In terms of the sectors where we are underweight on or underweight on consumer is largely premised on still higher valuations and also pressure on growth rates emanating from high inflation and possibly some issues in specific demand in specific categories. Or underweight in oil and gas is premised on high volatility of oil prices and gross refining margins, and also valuations slightly being on the higher side as compared to longer term averages. Coming to the debt part of the portfolio, this is quite conservatively managed, where we have exposure across all the subcategories of debt, such as T-bills, bonds, and G-SIBs, where the focus is very high on credit quality as well as on accrual. Right now, we have a duration much on the shorter side. Overall, the fund is a very good blend of debt and equity, and we expect the same to continue with our focus on being value oriented. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.